updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 3:40 on Wall Street. I'm Denise Pellegrini, and this update is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Your small to medium-sized businesses could qualify for up to $26,000 per employee if you keep them on payroll during the pandemic. If you kept them on the payroll during the pandemic, it is simple and easy to see if you qualify. Learn more at getrefunds.com. And we do check the markets for you all day long here at Bloomberg. Cold wind blowing on Wall Street as those sub-zero temperatures move in. And investors worry that stronger than expected jobs report could mean more Federal Reserve rate hikes. Anastasia Amoroso, Chief Investment Officer at iCapital, says the strong jobs data is a good sign about the economy, but
I do worry that this challenges the view that Fed Chair said just a couple of days ago, which is that disinflation has started and it's soon going to start in the services part of the economy. I think it challenges that view, because if you have 11 million jobs out there and people are going to find jobs, that still creates some wage pressure, and 4% year-over-year wage growth is just not good enough for the Fed.
And with all that happening right now, the Dow is down 0.4%. The S&P 500, it is down 1%, and the NASDAQ is down 1.5%. The yield on the 10-year Treasury sitting at 3.5% right now. Slump in commodities, spot gold down almost 2.5%. And West Texas crude, it is down almost 3.5%. Twitter may charge brands $1,000 a month to keep their gold verification badge, and $50 a month for each affiliated account. That is the word, according to internal messages viewed by The Information. And that is a Bloomberg Business Flash. Carolyn.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we've got less than 17 minutes left in today's trading session, and it's been an interesting one in a week that has just been full of so much. Of course, the monthly jobs report, and you are seeing stocks well off their best levels of the session. The tech names taking it hardest hit, really, if you will, on a percentage basis, down about 1.5%. Tim, we're still up more than 3% on the NASDAQ for the week overall, and up 1.6% on the S&P 500.
I'm confused.
Why?
I'm confused about the reaction to today's jobs number. Between that, the other economic data that we get the JOLTS data that we got earlier this week, and of course we heard from Fed Chair Jay Powell, it seems that, certainly the bulls are winning. And given the strength of the jobs report today, I'm surprised that I'm not seeing more of a sell-off. I think, I was talking about this earlier with Scarlett and also with John Tucker downstairs.
Yeah.
He made a good point that wage growth was in line with expectations. And maybe that has people kind of tempered.
That's one of the things I heard Mike McKee talk about earlier, that in terms of wage gains, and I think Molly mentioned it too, up, but less than the month before.
Yeah.
And so if we're seeing those wage pressures go away, that would be a big thing. That's the inflationary component to it.
But how does wage pressure, again, you always remind me, this is backwards looking. How does wage pressure go away when there are still almost 2 jobs for every 1 person looking? And people can just easily jump from one job to another job. And that's the best way to get a raise.
If people are getting nervous, maybe they don't push so much. But let's see what it all means potentially when it comes to the investment environment. So let's get to it. Let's get to the drive to the close. Vance Howard is back with us. He's CEO and portfolio manager at the fee-only registered investment advisor, Howard Capital Management. He joins us via Zoom from Roswell, Georgia. Hey, Vance, nice to have you back with Tim and myself. What a week. I am exhausted. Tim's exhausted. It's a little crazy. How do you see all of what came at investors, including the big tech earnings, the FOMC meeting, the jobs report? Sum it up for what it means for potentially the markets, financial markets.
I think it's great. I mean, I think that we've turned the corner. Our proprietary indicator, the HCM byline, went positive about 2.5 weeks ago. This is Well, it went negative in January of 2022, so we've sat in a whole lot of cash up until the past 2 or 3 weeks, and we've been buying. The S&P went above the 200-day moving average, so on a technical basis, I think you've got to put aside a lot of the news out there and start trading what actually is happening in the markets, which is what we're doing. And we're a buyer. We've been buying quite a number of things. We've moved from about 50% to cash now to about 20% in cash, and we'll continue to buy into any dips that we're seeing. You know, today's pullback.
Wait, that 50% cash to 20% cash, how quickly did you move on that?
In about 5 to 10 days. And so we started buying quite a bit of things over the past 2 weeks. And we've even started buying back the bonds. Our bond indicator went positive too. So we started buying, emerging market bonds and long-term treasuries.
What was it that shifted in this rally? Because we've seen other rallies over the last year, and they've been false starts. I'm not saying that this one's not.
Well, me either. I'm not saying that either, but you have to trade what actually is going on, and the trend has actually changed. We did have a false start about right after the February, March area when the market wanted to rally right up after that big sell-off. But other than that, it's pretty much been kind of downhill the whole way down with a few minor adjustments, with a few minor buying opportunities that would present themselves if you're a short-term trader. But this is the first time in the whole year that we've seen the longer-term trend turn back up. Not the short and the intermediate term, but the longer-term trend. That's a very, very positive indicator right there. And I can tell you right now, with the HCM buy line being positive, your odds are 73% chance it's going higher, 27% would get whipsaw. So at a 73% chance of moving higher, you take that trade, you start buying.
All right, you got to take a step back. For those who maybe didn't hear you last time, you talk about this HCM buy line. I know it's proprietary, but what can you tell us about it? That it's an indicator that looks at what, so that our audience kind of has an idea of what maybe triggers it.
Yeah, nothing complicated. It's a trend indicator. It's a very very sophisticated trend indicator that has a high level of accuracy. And like I said, it turned negative in January of 2022. Of course, we sat in a whole lot of cash, but it was still a rotten year for everybody, even if you're sitting in a lot of cash. And then, of course, but this is the first confirmed buy signal that we've had on the longer-term trend of the HCM buy line. This is a very positive thing. So all this news that's coming out, I tell people, you got to trade what's happening right now because we don't know what's going to happen tomorrow. Yesterday's gone. The trend's up. You got to start taking trades.
Well, it does happen next week because we do hear from a lot of Fed officials next week, including Jay Powell. And I've got to think, given his reaction to financial conditions easing, his reaction to rallies over the last year, sometimes he comes out and squashes them or says things that squash them.
Well, he came out with a 25 basis point hike right there, and that was just a wonderful thing. His rhetoric that he had wasn't that negative towards the market. I think he feels pretty good about inflation starting to calm down. When you look at the PCE index, that's starting to roll over. That's been a big key thing that Fed Chair Powell has been looking at. So I think you got a lot of great things going on here. And the cash buildup, guys, I'm telling you, we watch cash buildup. This is the largest amount of cash buildup I've ever seen in 35 years of doing this. So this thing's got a lot of fuel to go higher. And if
what specific metric are you watching when it comes to a cash buildup?
We look at a number of different things as far as cash buildup. Money market flows that are going in just money market accounts. We try to look at that, and that number has been very, very high. So there's a lot of investors with a lot of cash. And you got to remember, too, this is the first year in 40 years where bonds have just taken an absolute beating. Mm-hmm. So you saw a lot of investors sell bonds and go into cash, but now they're ready to go back into the bond market or ready to come back into the stock market. And I think that's going to be a real big positive going forward in 2023.
Hey, looking at your buy list, just a couple things jump out. iShares U.S. Technology ETF, also the iShares Semiconductor ETF. So you're all in, it sounds like, when it comes to tech.
Yeah, we were buying those 2 weeks ago, so we've had a pretty good run. The past 2 weeks have been very kind to us. And I do like the ETFs better. Let me tell you why. I think that some of these stocks are going to take really have nice, powerful jumps up, but they're also going to take a beating if they miss on any. Like look at Snap. Snap got just beaten to death over there for their earnings. I think you're better off broadening it out with an ETF and not taking individual stock risk in a market like this because a lot of people were hurt in 2022. A lot of fear out there. So just any kind of negative news shocks people, and they'll pull the ripcord pretty quick on an individual equity.
Vance, good stuff. Love having you on the program. Let us know when you're back in New York. It was great to get you in the studio last time, too. Appreciate you taking the time.
All right, Vance Howard. He's Chief Executive Officer, Portfolio Manager at Howard Capital Management via Zoom from Roswell, Georgia. I was just pulling up the S&P 500. I mean, we have stayed above that 200-day moving average for a couple of weeks, it looks like, at this point. So a significant trend line there. We shall see. We'll see what next week brings, especially with all the Fed speakers, Jay Powell in particular, on Tuesday, whether or not he tries to talk back and is he more hawkish and whether that changes the tone.
All right, we'll see.
We shall see. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And from Bloomberg World Headquarters in New York, I am Denise Pellegrini, and we're checking markets for you. And all the company news, Apple shares, they are lower. Apple reporting lower than expected sales for the quarter. Weaker than expected economy hurting Apple there. You know, this is the first time Apple missed analyst estimates since 2015, but I misspoke there because Apple shares, they are actually surging 2.5% on long-term confidence about the company. Google parent Alphabet reporting weaker than expected ad sales. Also lurking in the background there, those continued threats from the Justice Department about breaking up the search giant's ad technology business. Sales at Amazon coming in below estimates. Amazon shares are lower, and sales at its lucrative cloud computing business, well, they will continue to slow through the year. And Anurag Rana, analyst with Bloomberg Intelligence, says it all has to do with the overall economic slowdown.
They said things were going to slow down, but it's actually worse than what they had expected. And my gut feeling is consumption has been much slower than that. You have, financial services firms, crypto firms, those are not, as active as before. The overall economy is slowing down and enterprises holding back on tech spending.
Meantime, Ford shares are lower. Ford is blaming poor execution and supply shortage for its underperformance last quarter. And BMW announcing it'll invest nearly $900 million in one of its plants in in Mexico to make electric vehicles. And those are the company stories we are following for you this hour. I'm Denise Pellegrini, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left in today's trading session. You know, I was going to save this for our TV colleagues, but...
What do you see? What do you see?
Well,
you can repeat it.
I was saying that one of the best performing stocks of the week was Meta Platforms. Was it the best performing? I'm going to pull it up.
Second best of the week, right?
Second best for the week. It is, yeah, second best for the week. And then you said, I wonder what it is year to date. And I pulled it up. I think it's the fourth best performing stock for the week overall. But
for the week, and what about for the year?
No, it's the third best performing for the year. It's
Okay.
up 55%. Tesla's the fourth best performing stock
What
of
are
the
the
year in
first?
the S&P.
Do you have the first two up there?
Align Technology up
Okay.
63%. Warner Brothers Discovery up 63%, which we know has been kind of on a tear.
So it has, but look at what happened in 2022 to all four of those companies.
No, I know. No. Yeah, absolutely. Perspective. They got beat up. It's just interesting to see, you know, how much money has kind of got into, you know, the communications S&P
Yeah.
group, but that includes a lot of your big tech names.
Who I can't remember the guest who we had earlier this week or late last week talking about communication services and the way that, you know, the way that they.
Kathy Wood again?
You know
But
what?
you're right. Somebody talked about it. Like
You ask me
and
questions you know I can't answer. It's not fair.
Your mind is like a steel trap. You
Ari
always remember.
usually comes in and tells us who it is because he's got a great mind and he remembers every interview.
It's an interesting day, though, and I really thought the markets were going to fall apart after this morning's jobs report came in much hotter than expected. That unemployment rate dropping to the lowest in, 53 years?
1969.
I mean, it's like unbelievable, and then to see that kind of job creation. But I don't know. Part of me wonders, like, it's that thing, if the job market can kind of hold up, even if growth slows, could we get that soft landing? And can the Fed continue to raise rates a little bit to make sure they dampen, cut inflation, and get it back to that 2% that they keep saying they're committed to?
What's Jay Powell going to say next week? Also, is a jobs report like this inflationary? Maybe it's not because the earnings, the earnings data showed that it was in line with expectations.
Right. But a little bit less than the prior month.
Yeah.
So that's a good trend line. I mean, one report. Let's see what happens in a month. Isn't this what...
Say it every month.
We're data
one report,
dependent.
right?
We're data dependent, just like the Federal Reserve.
You and Jay Powell have so much in common, Carol. You're both data dependent.
Our bank accounts look a lot differently, though. I'm just going to say that. All right, guys, it's time to head over to our TV colleagues. Let's cut you down. Wrap up the week, wrap up the day. Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
Just under 2 minutes away from the end of this trading day on this Friday, I'm Scarlett Fu here with Katie Greifeld, counting you down to the closing bell, here to help us take you through the bell and beyond with a global simulcast, Carol Masser and Tim Stenovec. That brings together our Bloomberg Television, Bloomberg Radio, and YouTube audiences worldwide as we parse through and just kind of make sense of this trading day. Carol, were you surprised?
I can't make sense.
I know. Were you surprised by the journey that we took on equities, where we went to unchanged for a while in the midday?
I think it's so wacky. But, you know, I think people just don't quite know what to make of this. Like, you know, we talk about the economy slowing. We talk about the Fed continuing to raise rates. Jay Powell said that. You know, there's concerns, there's weakness. And yet, Katie, we continue to see strength in the labor market.
Can I just say the one guiding light we had today was the bond market. That market sold off, yield soared, and we stayed there. And it feels like that really led the equity trade today.
But we didn't go to a new high, right, in terms of yields. We stayed within the range.
Well, I mean, that's just because we had such a massive rally. But I mean, 20 basis points on 2-year yields, that's the biggest move in at least a few months.
All right, we just spoke to Vance Howard. He's the CEO and portfolio manager at Howard Capital Management. We've talked to him before. He's got this proprietary thing. They call it the HCM buy line. And it's sending a buy signal right now for the first time in a year. They've gone from 50% cash to 20% cash just in a couple of weeks. He says this time is different.
Maybe, maybe not. I mean, people were definitely listening to some kind of buy signal earlier in the day, although it's questionable whether that was short covering, whether that was any kind of tactical positioning ahead of some other big headline events next week as well.
Yeah, it's pretty amazing. And what a week. I mean, we're still going to end up with some really significant gains for the week overall. So, you know, net, Scarlett, gains for a lot of investors.
All right, and if we look at the industry groups, of course, the S&P 500 finished 1% lower, the NASDAQ 100 1.6% lower. If you look at the industry groups, it was a lot lower as well. We did have some green up there. We have tech, some of those tech names did make it into the green. That is, banks also had an okay day. JP Morgan had a big day, but again, it was a lot of red on this screen. Right at the bottom, you have retailing, and Carol, a lot of that is just from Amazon.
Yeah, no, that's a really good point. All right, let's get to some of the specific gainers. I'm kind of obsessed with Tesla because it continues to move higher. This stock is now up 60% year to date. Wow. It was top in the NASDAQ 100 and the S&P today. Tesla fraud trial wrapping up in San Francisco. I will say by the end of the day, I mean, earlier it was up almost 6%, ending the day with about a 0.9% gain. Story last night about Tesla expected to announce an investment in Mexico very soon, and then you had Tesla shipments of Chinese-made, Chinese-made cars climbing 18% in the month of January, despite somewhat quieter Lunar New Year break. So we talked about the price cuts, and maybe that helped kind of spur some of the buying. But nonetheless, it's been on a tear, we know, here in 2023. Apple, let's bring it up. It is up about 2.5%, top of the NASDAQ 100. We know the story. Disappointment last night, a disappointing quarter hurt by supply chain snags. But instead, it seems like investors were really focusing on the company's longer-term prospects. So kind of interesting. And remember, Tim Cook talking about a rebound in China. So again, sometimes it feels like we get some mixed signals. Nordstrom, can I mention, up about 25%. News last night, stock jumping. Activist Ryan Cohen building a large stake in Nordstrom. And we've had some analysts come out and actually upgrade the stock. So really on a tear, $5.24 of the stock closing at.
It's amazing seeing what Ryan Cohen has been doing over the last couple of years. You got the gainers, Carol. I got the decliners. Ford finishing the down 7.6%. Katie, you talked about this one earlier. The company missed earnings expectations for the most recent quarter, blaming poor execution and supply shortages. Deutsche Bank, interestingly enough, came out and downgraded its rating on Ford shares to sell and said it was skeptical that management can actually achieve the $2.5 billion in cost savings that it's targeting for 2023. And then you got Amazon down 8.4% today. Expenses rose faster than sales for the 6th quarter in a row. Andy Jassy, the CEO, said his #1 priority is getting those costs under control. And we actually saw some brokers raise their price target on the stock for the company, but still down 8.4% today. And then Gen Digital finishing the day down by 9.6%. This is the worst performing company on a percentage basis in the S&P 500 today. They own Norton LifeLock. They do other cybersecurity as well. They provided 4th quarter revenue forecast range with a midpoint that fell short of expectations.
All right, let's move on to the bond market now. It's my favorite thing to talk about, and we are looking at quite a sell-off here. 2-year Treasury yields up 19 basis points. Carol, to your point, still in the range, but looking at it, that is the biggest one-day move since about June. So you also saw some selling across the curve, really. 10-year Treasury yields back above 350. We're talking 14 basis points there, and that selling continued across the curve. But you add that together, you did have the yield curve invert further, now down to about negative 76 basis points. So again, a lot of selling. Is this a readjustment? Is this maybe what gets us out of the range? I'm not quite so sure.
Yeah, we'll need more time before we can determine that. You mentioned how the bond market has been very consistent all day today in selling off, pushing yields higher. What else has also been consistent is the dollar. Dollar much stronger today, gaining versus most of the G10 currencies and most of the major currencies. No one's saying that that trend has been broken where people are calling for a weaker dollar in 2023. But if the dollar does move in another direction, it calls into question what the earnings outlook will look like for a lot of these companies that make their profits overseas.
Right, exactly. We were talking about this weaker dollar that we've seen as of late, how that could give a kick to some of the earnings momentum out there. So we shall see. I want to point out, I put out a little Twitter survey. I said so off of the jobs report, no rate cut this year. rate cut this year, not easy being the Fed. 46% said no rate cut this year. Only 11% said a rate cut this year, and about 43% said it's not easy being
They're
the
still
Fed.
waiting for it. You're telling me there's a chance.
That's what, yeah, that's true. It goes back to what you sent out yesterday, Scar. That's an interesting response, given what you've seen the market doing, because the market is certainly pricing in that there's going to be a cut, but the folks who voted in that poll, not so much. I'm still thinking about earnings for the week ahead. We got next week, we got quite a slew of earnings continuing. We got Disney, we got Activision, we got Chipotle, we got Take-Two, just to name a few, Katie.
I'm going to be in Miami all week, so I'm not quite sure about the earnings. I am also looking forward to Jerome Powell. He is going to be speaking on Tuesday, so I'm going to tune in for that. But, I mean, it gets back to that conversation about what would actually cause a rate cut in 2023. Is that a recession? Do things deteriorate to the point where, you know, the Fed actually eases, or is it just getting back to neutral? If we are truly in restrictive territory, I mean, maybe they just return to neutral.
How do you return to neutral without, if we're in restrictive territory and you return to neutral and then you still have to cut rates, but you don't get a recession, a hardcore recession? I don't understand how it all comes together.
Well, that's the rub of it. I mean, why are we pricing in rate cuts? What would actually get it there? I don't have a good answer.
I'll tell you that 517,000 jobs being added in the most recent month is not saying that we're in a recession.
I mean, this is
that's not recessionary.
But I also do wonder, by still seeing some strength in the labor market, again, does it give Jay Powell and company some room to keep doing what they need to do to rein down and, you know, bring down inflation and make sure it stays there? I mean, they stuck to that 2% target, so we know we've got more momentum to go. But does it give them some room to continue doing it and hopefully get the economy to a good place? Hopefully,
I think there's a lot of looseness around that 2% target, right? Is it 2% or is it like 2.5%, 2.8%? I don't know. There are people. Stephen Stanley of Amherst Pierpont was just telling us that he thought if the market's seeing, you know, getting close to 3% or
Jay Powell doesn't
getting
say
towards
that.
it is enough. But the market
doesn't
does.
say that. Yeah.
Well, I think that's also because, I mean, if they showed any willingness at all, any openness to the idea that they're, you know, abandoning 2%, can you imagine? That would be huge news. I mean, what that would mean for markets.
That would be a pivot.
Does it
exactly?
Does it seem like to you that the market is taking seriously what Fed Chair Jay Powell is going to do for the rest of the year? What the Fed is going to do for the rest of the year?
I think they're going to take him a lot more seriously on Tuesday, really. I think that, you know, what we got this morning at 8:30 a.m. and then what we got out of ISM services, the fact that, you know, things are still pretty tight, pretty hot when it comes to the economy. Maybe now they'll listen to him when he says our work isn't over yet.
Don't we get a read on inflation? We get another CPI right on Valentine's Day. Happy Valentine's Day. It's going to be a big one. And I do agree. I think the most important thing will be what Jay Powell says. Does he just reiterate what we got from the FOMC meeting, or does he have more of a hawkish tone or dovish tone? I mean, it's key.
It's so early, though, before the next Fed meeting, and he's got a lot of data points that he could point to that he can look at. So my guess, my money is on him saying that he's going to be data dependent. They're going to wait to see what the data show before making any commitments. But
which, of course, just means that we really pour over and overanalyze every single piece of data.
As we do here.
We never do
Hold
that.
on. Katie, what are you doing in Miami next week?
I'm at an ETF conference. It's the Exchange Conference. We have a big day planned on Monday. It's kicking off at 1 p.m. Eastern, so tune in.
You're doing the show from there.
We are. ETF IQ is going to Miami.
Tim, what do you do next week?
Taking care of a new kid.
We're looking forward to that. Tim will be back, though, we think, on Monday, unless something
if all goes according to plan, I'll be back on Monday.
All right. Fun talking about the markets, guys. It's been such a crazy week. Have a good weekend. We will see you again, though, all of us on Monday. Our cross-platform coverage, radio, TV, Bloomberg Quick Take, Bloomberg Originals, and on YouTube. We call it Beyond the Bell. We'll see you again, same time, same place, Monday. But, you know, she's all in when it comes to innovation disruption. She's got a new research report, and it really is touching on, she's calling it big ideas for 2023, but it's touching on so many things that we touch on a lot and as of late, and that includes something like artificial intelligence, Tim.
Yeah, and look, I think what's interesting, too, is the news that we got a little earlier today, Carol, that, you know, you have a series of companies continuing to invest in AI. with Google coming out and saying that it's making a big investment there. So.
And we feel like on all the earnings calls, like everybody.
Oh my
like,
God!
that's
Google
it.
yesterday, the first sentence from Sundar Pichai was all about AI. So, we see that there's a buzz around it right now, and we see that there's this euphoria. It's led to some wild swings in stocks like BuzzFeed, C3 AI. BuzzFeed saw triple-digit gains in certain days because of its association with AI. But what about when it comes to deploying AI for industrial uses? We've got a great guest with us. Alice Globus is CFO at Nanotronics. It's a company that says it uses AI to make the manufacturing process more efficient. She joins us via Zoom from New York City. So, Alice, I think a lot of people are familiar with what ChatGPT can do. I had a friend write a review for me in ChatGPT, and it actually was like almost good enough for me to actually use for my own self-review.
Really?
Yeah, it was pretty amazing. I didn't use it. But he was tempted to use it for his own reviews that he has to write as we get to review season. What about when it comes to manufacturing and making the manufacturing process more efficient? What's the tech that you have at Nanotronics?
Yeah, well, I just like to say thank you, Carol and Tim and Bloomberg, for having me here. With all the excitement about AI, a lot of people don't realize the uses that it has on actual physical things in our life. So one of the major problems with manufacturing right now is it's a very wasteful industry, and there's a lot of problems with manufacturing processes that cause everything from a lot of waste being manufactured to energy usage to all these other things, sometimes human accidents that really drive the price of our goods up significantly more than we actually realize. And then there's companies that have contamination issues that are dealing with like Tylenol or baby formula that you heard of. And this is where AI really can come in and take advantage by helping manufacturers optimize their systems in a way that humans just don't have the ability to do so. More because it's overwhelming as looking at a manufacturing facility. There's millions of things that are happening, and being able to assess that and optimize the process to have the best product possible.
Alice, are most of manufacturing, even some of the big, manufacturers that are out there, global manufacturers, aren't they doing this already, though, using AI to some extent to maximize the productivity at their facilities?
Yeah, like I would say they're using what I would consider early stages of AI. What you're seeing right now is really an AI revolution that's happening. What you're seeing with ChatGPT, they're using a relatively cutting edge technology that allows computers to learn the way humans learn. And this is what we're doing for manufacturing. When our systems are learning like a human does, they're penalized and rewarded based on what's happening. They learn through observation, all based on the end goals, which for most of our manufacturers, that's increasing their yields, but sometimes it's reducing their power consumption or other things that they're looking to achieve.
One thing that we talk about with AI is inputs and outputs. What are the inputs that you use?
Yeah, so it's kind of something that we do differently is we actually are not simulating what your factory or your facility. We actually use your real-time data that's coming, everything from your brain of your factory, which is known as a PLC, which is kind of takes all the sensors in your factory and puts it into one place. And we're able to take that, temperature, humidity, pressure, whatever that is, those sensors, in most cases it's thousands, and look at them to be able to optimize for the end goal of winning the game of manufacturing.
So enter Nanotronics. Tell us a little bit about your company, what you specifically do against the backdrop of this conversation we're having.
Yeah, so I'd say we're the first generative AI company for manufacturing. We started with early artificial intelligence for inspection, which of identifying defects within the manufacturing process. And that's not exactly the most sexy thing, but the reality is when you have problems in your materials, especially in industries where it's a long time to manufacture something like the semiconductor space, the sooner you can identify problems that are in your product, the quicker you could either address them in your manufacturing process or replace your supplier, communicate with your supplier that there's a problem with that coming in. So that allows you to increase your yields and reduce your costs in the overall process.
Talk to me about customers. Who do you have out there right now?
We're working with most Fortune 500 manufacturers. We have over 200 customers ranging everything from biotech to semiconductor to automobile industries.
How do you sell it?
Well, that's a good question. We've been in in inspection for over a decade. So this is one of those things that we started with, I would say, the hardest industry to penetrate, which is the semiconductor space. You know, they're really more lenient to going to some of the larger manufacturers. But right now, what we're seeing is that they're hitting a wall with what can be physically done by hardware. And the only way to overcome this is really through artificial intelligence. It allows our customers to able to do predictive maintenance, to actually have real-time feeds from supply chain distribution, like their ERP systems, such as SAP or one of those systems, to change their process based on shipment delays or even people that are interfering or fatigue that's coming into the process. So these are things that we're able to take into account and help optimize.
You know, Alice, I kind of keep thinking, we've been talking about AI for years. This isn't new. It's been around since the 1950s. But I do wonder, you know, and you mentioned generative AI, which is this idea of generating novel content, right? Like Chat GPT. Was there something that has happened in the last year or so that all of a sudden we're talking about AI, and rightfully so? I just want to make sure that our level of focusing on it, I mean, we see companies obviously doing big deals like Microsoft, and we see Google doing a much smaller deal, but nonetheless, these are big names involved in it. But I mean, are we rightfully focusing on it right now because there's some new development that has made it much more useful in our world?
So actually, the big breakthrough in some of this generative AI technology happened in 2017. And I think why it's taken so long to actually get into the mainstream is that there's been a lot of R&D that's surrounding it. And it's honestly a combination of human acceptance of AI and willing to take the chance of giving over control to a black box system.
And that you mean in the corporate world, right? When you talk about
the corporate world. In the corporate world for sure. And then, you know, coming with AI for like ChatGPT, these techniques have been developing since 2017. There was a scientific paper that it really stems from this. But, you know, there's been advances in speed and internet speed connectivity. These things also help increase adoption of AI within just a social setting.
All right, we only have 40 seconds left here. What was it like to work with Neil deGrasse Tyson? Just quickly, which you did do. You're an astrophysicist. Just quickly, what was it like?
You know, it changed my life. I always say that I encourage everyone to get their PhD in astrophysics because it shows that no problem is too small to fix. You know, we were trying to solve some of the universe's largest problems, and when I look at, you know, something like manufacturing and be able to have carbon negative manufacturing facilities across the world being optimized through AI, it actually seems like an attainable future that we can do. And, you know, it was definitely an incredible experience.
Well, I love the optimism, and I like the idea that no problem is insurmountable. So really great way to start to wrap up our Friday. Alice, thank you so much. Alice Globus, she is Chief Financial Officer at Nanotronics via Zoom from New York City.
ChatGPT is going to replace me next week. That's who you're going to be working with.
It's already replaced me.
Oh, that's what's going on?
I'm also an avatar. No legs.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 4:21 on Wall Street. We do check the markets for you all day long here on Bloomberg. And the jury in Elon Musk's trial over his tweets 4.5 years ago about taking Tesla private, well, that jury has now begun its deliberations. And that is after a lawyer for the chief executive officer argued in a San Francisco court that Musk is not a, quote, fire-breathing tweeting monster. Stocks overall closing lower. That's after that monster of a jobs report popped investors' balloon today. The Dow closing down 0.4%. The S&P 500, it closed down more than 1%, and the Nasdaq, it finished more than 1.6% lower. Techs weighing on sentiment as well. Google parent Alphabet down 3.2% at the close. Amazon down almost 8.5% after reporting quarterly results. Not Apple, though. Sales slowed at Apple, but it is still the apple of investors' eye. Apple shares slowing closing 2.4% higher. And that is a Bloomberg Business Flash. Carol and Tim.
All right, Denise, thank you so much. Well, we do love to check in on the restaurant industry.
It's because I love eating.
And someone who's witnessed all of the eating while we travel together. He does love to eat. Our next guest knows a lot about the business. He's got around 400 employees in 15 restaurants in places such as Long Island, New York City, Florida, and LA. So a good cross-section.
Yeah, very pleased right now to be joined by chef and restaurateur John Fraser, founder of JF Restaurants. He joins us via Zoom from New York City. He's behind such restaurants such as the Lobby Bar and Paradise Club inside the Times Square Edition, the Mediterranean-inspired Iris, the Brasserie La Marchande at the Wall Street Hotel, and many more. John, good to have you with us. How are you?
Thanks for having me. Great. Thank you.
Yeah, thanks so much for joining us. Okay, so we're going to talk Valentine's Day. We're going to talk reservations, but I just want a read on how the industry is right now. We got the jobs report today. I'm guessing it's still tough for you to find employees. Is it?
It's actually our biggest challenge. What we're seeing is an increase in demand, right? People want to eat out and people want to join us at our restaurants, but in many of our restaurants, we're not even open yet 7 days because we don't have enough staff.
Still?
Wow.
So you would be open 7 days a week at some of these restaurants if you could find the people to do it?
Not some, all. We'd be open at all of our restaurants if we were fully staffed. And I think that that calls into question a couple of sort of where did everybody go, right? One of the questions, and who's going to backfill those jobs over time. My sense is it's probably not a laid off software engineer. This is a highly skilled environment we work in restaurants, and I think that we're still looking for the answer.
John, where do you think the people went? I mean, the people coming back, are they the kind of people, or the people who were working before the pandemic, or is it changing?
Yeah, many are. We went through a couple of cycles of employee through this kind of process since the last couple of years. Many are returning. Many are upstarts, people that had never worked in restaurants before. I'm not totally certain. I mean, there are other parts of the country that exploded with restaurants, and my sense is that many of the professionals moved where there was work. I think that a lot of the restaurant industry is a quilt of the world. We receive people from all over the world in our back of house and front of house positions, and my sense is those folks haven't yet returned.
It's remarkable to hear that, because this is a struggle that's been going on for 2 years now, John. What about when it comes to the other costs that you're dealing with right now? Food costs.
Sure.
Are those coming down?
All the way across, we're starting to see at least costs. Let's say they stabilize. We were in a moment of not knowing what next week's shortage was going to be. It feels to me like we've stabilized in terms of predictability. That being said, costs are still high. I don't have an exact percentage for you, but on one hand, we're all in competition for the same guest, and we need to be careful about our pricing. On the other hand, we basically have no choice but to have risen our prices over the last, let's call it, year.
Are margins okay though, because those costs are going down, but you're keeping prices where they were?
I wouldn't say margins are okay. I think our biggest struggle on margin really is our labor cost. the sort of bottom rung of labor rose, and that bottom rung basically has caused all of the other, of course, wage rates to go up. And I think that we're starting to see things, again, somewhat stabilize and become predictable, which is a great news for us. That being said, how much of those cost incurrences can be passed on to the guest? That's kind of the conversation, I think, for 2023.
So, John, because you can't find all the workers you want, are you not back at pre-pandemic levels?
We are not. In terms of revenue, we're not, though we are, 40% better than we were last year. Let's not forget we were in the middle of Omicron at this time last year, so not a hard bar to beat. But what we're seeing is especially in New York City, huge tourism demand, but we're not quite there in terms of being able to fill that demand because of our lack of staff.
But here's what's interesting. I was reading on your website, you're growing, you're expanding. You're not just expanding around the country, but you're adding new restaurants in places where you already have restaurants. What's the thinking there?
We are. Well, the thinking there is that we have a responsibility to our shareholders to grow. I think that there is a thought that this year will be something has to break, and I'm hoping that will be somewhere between rational immigration and people returning to hospitality jobs, whether it be because they come back to urban areas or because they become fruitful again. I think that if you would have asked me if I was a captain in one of our restaurants a year ago when I was waiting tables during Omicron, I would say, are you happy? I'm not certain I could say yes. And I think that we're being, as a group, and we have a responsibility to do this, we're providing some sort of stability for them in terms of how much money they're going to be able to make and predictability for their schedule, which I think is maybe two of the top reasons that people work in restaurants in the first place.
Right. John, hey, you mentioned your investors, and Tim and I just did a quick check. We're like, wait, did we miss? Is JF Restaurants, are they public? You aren't. You're private, but you obviously have investors.
No, it's private.
Yeah. Is there pressure, though? I mean, is that the end game for you guys to become a public entity?
I don't think so. Most of our restaurants are in highly specialized areas. We have fantastic partners like Blackstone and Marriott in the Edition hotels. They're our partners, and we're lucky to have them. I don't know that our restaurant group necessarily has the DNA to go public. We're highly specialized in highly specialized locale. If we were to expand out at that rate, I think it kind of changes who we are. It's not to say we wouldn't be interested in it, but that's not the end goal.
How do you provide a return to your shareholders? Does it all just come down to the profits at the end of the year get split among your investors?
That's it. Every one of the restaurants is either a partnership or licensing deal with, as I said, a conglomerate like Marriott or Blackstone, or privately owned with myself as an investor, and all of those units are treated individually with a P&L statement, which is hopefully results in profit.
What's this? How do you scale this? When we think about it from the perspective of operating each individual restaurant, that's expensive. So the incremental costs per restaurant continue to go up if you add another restaurant. Where are the economies of scale here?
Sure. Well, my restaurant group in particular, we're on one hand a service provider. In other words, we license restaurants and ideas to people like Marriott, right, or companies like Marriott. So the scalability really depends on Marriott to buy into our individual collaborations. On the other hand, there's the ownership side, the restaurants that we're partners in, and those I think. We're a very young restaurant group in terms of the number of restaurants that we have in comparison to some of the big monsters that are able to go into, cities without a ton of investment, meaning they're able to roll into their own investments. I think the scalability is still under question for us. I'm not certain that that's the place that we want to really spend a lot of our time until we start to see the market and the economies recover. And at that point, I think that there's probably a conversation around scaling brands like Iris or brands like La Marchande into other cities.
Right. But John, you definitely work, at the upper end of the economic strata, if you will, right? I mean, and I don't know if you're nothing's immune completely from the cycles of the economy, but to some extent, I guess it's a little bit better. Is that fair to say?
Define a little bit better. What do you mean by that?
Well, I mean, in terms of if we go into a recession, a downturn, are you going to feel the impact?
Oh, absolutely. Yeah, absolutely. I would say the big piece of it would be on the demand side. I mean, no one is immune from a downturn. And if Omicron is an example, an extreme example, I mean, we were back on our heels in feeling like COVID again, with the hope that things would recover, and they did, luckily. But an economic downturn, affects all of us. It may loosen up the labor market slightly for us, but I would prefer a tight labor market and a high demand.
Interesting. I love it. Hey, listen, just got about 30, 40 seconds. Looking at the notes that, people want experiences, and sometimes there's tableside theatrics. Can you just quickly give me an idea of what? And again, just got about 30 seconds.
Sure. Yeah. Sometimes we light moussakas on fire, and other times we're making cocktails, and we have a fantastic champagne cart that kind of rolls around and gives you an introduction to, sort of the scale and type of champagne, as well as what you can do with it, whether it be a champagne cocktail or, poured over a dessert.
Well, I have to say, I went to a restaurant this week and had my first bread course, which was in heaven. The idea of a champagne cart, that certainly speaks to me.
Did you say bread course? That sounds awesome.
It was awesome. A champagne cart would also be awesome. John, this was really fun. Come back, hopefully in the future, and we can check in with you and see how things are doing. John Fraser, restaurateur and chef, founder of JF Restaurants, joining us via Zoom from New York City. You would love the bread course.
I would be all over that. That's all I would eat.
It was incredible.
All right, I'll do it.
I'd never been anywhere and I had a bread course. It's not like a bread basket, a bread course.
Sounds good to me. Let's go to World and National News. Nancy Lyons is in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Secretary of State Antony Blinken will not be making his way to China this weekend after all, and it has to do with a Chinese surveillance balloon that is moving right across the U.S. China says it's a private weather balloon that blew off course. The U.S. doesn't buy that story. Secretary Blinken says he informed Beijing earlier today about his change in plans.
In my call today with Director Wang Yi, I made clear that the presence of this surveillance balloon in U.S. airspace is a clear violation of U.S. sovereignty and international law.
Secretary Blinken says he told them the U.S. remains committed to diplomatic relations with China. He plans to visit Beijing when conditions allow. Well, President Biden is crediting his economic policies for the creation of 517,000 more jobs last month and unemployment coming down to 3.4%. Bloomberg's Irv Chapman has more in today's better-than-expected jobs report.
The president previewed a major theme of his forthcoming State of the Union speech.
Today, I'm happy to report that the State of the Union and the state of our economy is strong. The strongest job growth in history, the lowest unemployment rate in 54 years, more working-age folks coming to the labor market looking for jobs last month than have in a long while. The economy growing at a solid clip.
The president contrasted that record with the economic distress when he took office, when he said inflation was already soaring. In Washington, Irv Chapman, Bloomberg Radio.
U.S. agriculture officials have proposed new nutrition standards for school meals, including the first limits on added sugars. The proposed change would focus on sweetened foods like cereals, yogurt, flavored milk, and breakfast pastries. The plan would also dramatically cut sodium in school meals by 2029. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It is 4:40 on Wall Street. I'm Denise Pellegrini, and this update brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. The sacrifices you made to keep your employees on payroll during the pandemic are not forgotten. Check the potential refund your small to mid-sized business may be eligible to receive through the Employee Retention Act with no upfront costs. Learn more at getrefunds.com. And we do check the markets all day long for you here at Bloomberg. And we're also monitoring the situation with Elon Musk and that trial over his Tesla tweets. The jury has begun its deliberations now. The class action suit accusing Musk of being responsible for stock losses, you probably recall, because of all those tweets about having financing secured for possibly taking the company private 4.5 years ago. U.S. jobs report jolting investors today. That jobs report coming in far stronger than expected. And Mohammed El-Arian, Bloomberg opinion columnist, is also former CEO of PIMCO.
It's a three-part reaction. One, wow, stunning, awesome, great for the economy. Two, there's a bit of a puzzle. And three, there's a hope. So the stunning bit is the 517,000 job creation. You know, the top estimate was 300,000. This is way out of the league, and this is really, really good news for the economy.
Yeah, really, really good news for the economy, but bad news for stocks, at least today, as investors worry this could tilt the Fed more hawkish again. The Dow closing down about 0.4%. The S&P 500 down more than 1%. The NASDAQ closing down 1.6%. The yield on the 10-year Treasury hovering at 3.5%. West Texas crude and gold both slumping. NYMEX crude down 3.5%. Gold down 2.5%. Couple tech stocks looking at today. Alphabet and Amazon both closing lower. That's after reporting quarterly results. Amazon down significantly. And that is a Bloomberg Business Flash. Carol and Tim.
Denise, can we talk about kitty litter again?
Kitty litter. Well, Clorox closed about 8% higher. Apparently, a lot of us got cats during the pandemic, and we are keeping them. And anyway, it's the sweet-smelling spot.
I hear you. All right, Denise, thank you so much. Well, remember earlier in the week, everybody, we talked about the king of ETFs with Bloomberg's Katie Greifeld and Joel Weber. We talked about SPY, the Spider S&P 500 ETF. Trust, it is turning 30. Happy birthday.
Happy birthday, SPY.
It's the biggest exchange-traded fund on the planet. It is massive. The story was about it's getting a lot more competition, but we talk a lot about ETFs, rightfully so.
Yeah, and next week is going to be a huge week for ETFs because the world of ETFs is going to gather in Miami next week for the ETF Exchange Conference. With what he's looking out for, let's get to Eric Balchunas. He's senior ETF analyst at Bloomberg Intelligence. He joins us on the phone this afternoon. Eric, good to have you with us this afternoon. So Miami, it's full of crypto and parties and ETFs.
Yeah, it's funny. They used to have this conference in Hollywood, Florida, which is right near Fort Lauderdale. But like so many people used to just go after the day's event, they'd drive to Miami for like the dinners and parties, that they just ended up moving the event to Miami. Although I really like the Diplomat. That's a really cool hotel. But anyway, and I also like that it wasn't in the hot spot. I think ETFs are a different breed. They're not like Miami just seems more hedge fund to me. But anyway, it's in Miami. And it's at the Fontainebleau Hotel, which is a storied hotel. And what they're going to do, look, they try to get advisors in there who are big ETF users and also the issuers and just talk through a lot of issues of the day. It'll be everything from macro talk, what to do when the 60 and the 40 go down together, which they did last year.
That's never going to happen again, though, right?
Yeah, right. I mean, if the 60 and the 40 are up again this year. I think the 60 and the 40 moving together is like a byproduct of the Fed. So until the Fed stops controlling everything, it could be this way for a while where they both go up and down together. But that's going to open the door to novel products, alternatives, and we see a lot of panels based on that. There's also going to be a lot of networking, obviously, and then debates. The two things that seem to get the most debate lately are ESG and direct indexing, which is a challenge to the ETF structure. Those two things are what my team debates the most, too. So they're going to be prevalent there. And it's going to be a good time. I love wandering around. The day flies by. Right. I barely see the sun, unfortunately. because I'm so nerded out there. That's a good sign.
Well, I got to tell you, speaking of debates, we're debating why you are not on a Zoom camera, because we just saw you on television. Is it that you already changed into your jammies for the weekend and you just couldn't get on camera for us? We're just wondering.
Yeah, as soon as I'm on TV, I just rip off the shirt and go back to slob mode. No, there's some truth to that actually. But no, I like radio because you can just call in and it doesn't matter how I look.
But we're on YouTube and we're on Bloomberg Quick Take on Bloomberg Original streaming.
It's just, it's okay, Eric. We're looking at it.
Available on Zoom.
We're looking at a beautiful picture of you right now.
I'm just giving you
your headshot, so
Tim,
it's okay.
Tim didn't want to do it. He thought it too, but he's like, Master, you do the dirty work.
I always make her do the dirty work.
ETFs. I just feel like every day, there was a period where I felt like every day there was a new one. Do we continue to see the kind of creation that we used to see?
Oh, yeah. Yeah, no, it's more than every day. There's 1.2 ETFs launched every day. And if you want to go global, there's about 4 a day launched. So I'm an analyst and I can't even keep up with this. So this is why our team is expanding, honestly. But yeah, there's a bunch of new ones that have come out this year already, and some of the, I guess, more publicized ones that we're expecting to see come out soon are the Nance and Cruise, which is the Congressional Stock Tracker ETFs that track the portfolios of some high-profile Democrats and Republicans.
Love
and then
that.
Potentially, I'm fascinated to see how that plays out, because that's not really a political play. It's more, let me make money off of people who know maybe some stuff that's, but not that knowable.
Inside information to some extent.
But Eric, isn't this information? I
agree.
Doesn't this information come at a lag?
It's a little bit. It's like 30 days.
Okay.
But they back tested it and it still works.
Wow.
So,
brilliant. It's brilliant. It's brilliant.
Yeah.
Hey,
and
listen.
There's
oh, go ahead.
Go ahead. Sorry.
No. Please go. Okay. No, you go.
There's another one that.
Go ahead.
There's a great Portlandia sketch. You go. You can Google it. You'll thank me later. But anyway, the other one that people are wondering if it will come out, and I hope it does, is the Inverse Kramer ETF. That was a kind of a controversial filing.
Jim Cramer.
And that's one where they'd actively manage a fund to sort of figure out when he's real into something, just do the opposite. And that's I think more of a pop culture kind of product, but I think it'll get some buyers if it does well.
I want to see if it catches on beyond finance Twitter.
Yeah, I mean, maybe. He's very popular. I mean, he's probably one of the top 5 most famous financial media types. But also, there's going to be a lot of serious product comoming out from Capital Group, J.P. Morgan. Morgan Stanley, by the way, is launching their first ETFs this week. That's big. Morgan Stanley has 20,000 advisors with like $4 trillion. So once that whole ecosystem gets into ETFs, that's a good sign. So Morgan Stanley was the last big holdout.
What are the fees on these new What are the fees on these new institutional products?
They're low. So like Morgan Stanley's are all going to be below 20 basis points.
Wow.
JP Morgan had a hit last year with an active fund that's 39.
Wow.
Basically all the stuff that you used to pay like 80 for, JP Morgan, Goldman, Fidelity, it's all going to be available to you under 40, maybe even 30.
Yeah.
Capital Group, all their stuff is under 40. This is a big deal because advisors, I think, feel like they still are open to active. They just don't want to pay that much. And they know when they pay that much, it takes a lot to overcome the fees to outperform. But if you have a lower fee, it's a lower hurdle. Okay, I'm with it. So active has finally found its footing based on lower fees.
Someone who's an actively managed ETF fund manager is Kathy Wood, and Tim and I caught up with her yesterday. We just got about 45 seconds. Your take, Kathy came out calling ARK the new NASDAQ, sticking to $1 million plus for Bitcoin over a long time period, but not too long.
Decade.
Yeah. So your thoughts real quickly.
God bless her. I mean, look, all these active portfolio managers can't say anything because they got all these lawyers and compliance people. Kathy's able to basically take the whole stage with some of these calls, so you could say some of them are too outlandish. She reminds me of Gunlock in that she's able to stir the pot and get people talking. I don't know if I'd call her the new NASDAQ. What I would call her is maybe something like the next-gen NASDAQ. But, of course, Kathy's going to go that extra step, which gets everybody riled up, and that's what happened.
She definitely changed the conversation if you think about all the copycats when it comes to innovation and disruption that have come along.
Eric, 10 seconds. What do you call it, the hot sauce?
The hot sauce. ARK has almost no overlap with the S&P 500 or the NASDAQ 100, and that's a valuable commodity right now because you can get those other two things for free, basically.
Really good point. So much fun. Eric Balchunas, have a safe trip, a fun trip. We'll look forward to hearing about it when you come back. Senior ETF analyst at Bloomberg Intelligence on the phone in his jammies.
company news headlines on Bloomberg Radio.
And from Bloomberg World Headquarters in New York, I'm Denise Pellegrini. We do have some tech stocks in the Wall Street glare today. Google parent Alphabet missing earnings expectations, shares closing more than 3% lower. Amazon sales for last quarter beat, but current quarter guidance coming in a little light. Amazon shares got slammed down more than 8%. Ford also in the headlights. The automaker missing earnings expectations. We get more from Bloomberg's Charlie Pellet.
Denise, Ford blames poor execution and continued supply shortages. The results show Ford is struggling to rebalance the transition to electric cars from combustion vehicles. The company is counting on strong sales of gas-burning F-Series pickups and Bronco sport utility vehicles to help foot the $50 billion that CEO Jim Farley has committed to developing and building EVs. Denise?
All right, thank you, Charlie. And Ford shares skidding today. Kitty litter, though, was a winner for some two cleaning product companies. Bloomberg's Steve Rappaport explains what's happening there. Steve?
Kitty litter surprisingly lifted sales for Clorox and Church & Dwight. The demand fueled by a jump in pet adoptions during the pandemic. Clorox says its Fresh Step brand saw double-digit growth in litter last quarter. And Church & Dwight's Arm & Hammer brand of litter clawed its way to a record market share in 2022. Church & Dwight also unveiled a new product called Hardball that it says creates virtually indestructible clumps for no-mess scooping. In New York, Steve Rappaport, Bloomberg Radio.
All right, thank you, Steve. And those are the company stories we are following for you this hour. Clorox, by the way, closed almost 10% higher. I'm Denise Pellegrini.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. Let's get a check on the latest world and national news with Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The Defense Department says it is keeping track of a Chinese spy balloon now over the Midwest and moving east, and says it currently poses no threat. Pentagon spokesman Brigadier General Pat Ryder takes issue, though, with China saying it's a weather balloon that veered off course.
We are aware of the PRC's statement. However, the fact is we know that it's a surveillance balloon, and I'm not going to be able to be more specific than that.
General Ryder says the U.S. has told China the balloon is in violation of U.S. airspace and international law. The incident has prompted Secretary of State Antony Blinken to cancel his planned trip to Beijing. The state of our economy is strong. That's President Biden's takeaway from the latest jobs report, coming days before his next State of the Union address. 517,000 new jobs were added in January. The president says his first 2 years have been the strongest for job growth in U.S. history.
While we may face setbacks along the way, and there will be some, there's more work to do, it's clear. Our plan is working because of the grit and resolve of the American worker.
The blowout number is raising market concerns, though, about inflation. House Republicans are launching an investigation into the activities of President Biden's climate envoy, John Kerry. Bloomberg's Amy Morris reports.
The GOP is looking for any dealings with the Chinese Communist Party and left-wing environmental groups. House Oversight and Accountability Chairman James Comer demanded in a letter that Kerry turn over information by February 16th. Comer alleges that Kerry's current cabinet-level post doesn't require Senate confirmation, but appears to be giving him the ability to bind the U.S. to international agreements. The State Department says Kerry's office is committed to discussing its international efforts with Congress. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg. Back to you, Carol and Tim.
All right. Nancy, thank you so much. Really appreciate it. Update on world and national news. We had a really incredible week, a lot going on, and one of the highlights was our conversation with Kathy Wood yesterday.
Yeah, it was great to have her with us, Carol. We talked about a lot yesterday. We talked about AI. We talked about her big ideas. We talked about what her thoughts are in comparing her ARK index to the NASDAQ index. Take a listen.
If you take a look at truly disruptive innovation, which is all we do, and you look at other growth portfolios, large cap growth, growth generally, as well as the major benchmarks like the NASDAQ, you won't find much truly disruptive innovation in them. And so as we were getting hit so badly, what we also saw is investors taking tax losses in some of NASDAQ and other strategies and moving into our strategy, which was hit so hard because they did believe that we were going to rebound faster. We were hit the hardest. Our research would suggest that the $200 trillion that we expect by 2030 to be the market valuation placed on disruptive innovation, that hadn't changed. That hadn't changed. And so if you have a 5-year investment time horizon, yes, you move into our strategy. And oh, by the way, we are the new NASDAQ, which is one of the ways we were trying to convey, look, if you want to look at the future and truly disruptive innovation, the way the NASDAQ performed in the 80s and 90s, that's where we went for innovation.
And that, of course, is Kathy Wood of ARC Investment Management. If you missed that conversation, first of all, it's going to be on our weekend show, 8 a.m. Wall Street time on Bloomberg Radio. You can get a lot of it. You can also check out our podcast.
Oh, by the way, we're the new NASDAQ.
Hey, listen.
That's a bold claim.
It certainly is. We just talked with Eric Balchunas how Kathy will do that. She'll lay it out there for you. The ARC Innovation ETF, by the way, it is up more than 40% this year, still way off its highs. Back, I believe it was in early 2021, but nonetheless, interesting conversation. That's a wrap for the week.
That's it. I'll see you on Monday, okay?
You better.
I will.
Hope. Fingers crossed. Have a good weekend. Sound on.
Ludlow in San Francisco. Caroline Hyde off today. This is Bloomberg Technology. And coming up, tech stocks drop as a hot jobs report adds pressure on the Fed to keep raising rates. Plus, warnings from Amazon and Alphabet weigh on shares as big tech gets hit by the slowdown. Even so, the NASDAQ 100 rises for a 5th straight week as Apple gains. And the cyber attack, which sent derivative trading back to the 1980s, we've got the Bloomberg scoop on how vulnerability at a little-known software firm led to some brokers going manual. But first, we've got to talk about these markets. A really hot jobs print for the month of January, putting pressure